Personal finance practice problem using Excel, balance sheet accounts, and accounting equation. Prepare to get financially fit by practicing personal finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're down here in the practice tab as opposed to the example tab. The example tab in essence being an answer key. Information's on the left-hand side. We're going to populate that into the blue area on the right-hand side. We're focusing in on our balance sheet account categories. We're going to expand on the complexity, adding more accounts as we go through these practice problems. Remember that when we're thinking about the balance sheet, you can basically just tie that into your accounting equation. So if you have any accounting background, we're going to be working with the accounting equation. Just note on the personal side, the terminologies are typically might be a little bit different, and we're going to focus more on a cash basis, cash flow, than an accrual basis, noting that you can't get away from some accrual concepts. So you could try to vary whether or not you want to be more on an accrual or a cash basis as you go. We'll try to point out those differences basically as we go. Now, the accounting equation classical format for an accountant would be assets equal liabilities plus equity, or in this case, net worth. We're going to call it net worth because it's our personal finances. Many times for individuals, it makes more sense to call it assets minus liabilities equals the net worth. Same accounting equation. The reason up top, the accountants kind of like this is basically our balancing concept, meaning assets, the liabilities, and net worth are kind of two sides of the same coin. Assets are what we have. Liability is who has claims to those assets, and net worth is who has claims to the assets, meaning whatever assets I have, if I owe them to somebody else, then they're the ones that have claims to those assets, and the rest of it, in essence, is ours, right? That's the owner's, the equity, or in our case, the net worth, which is what net worth is. So that's why, from an accounting standpoint, we like this setup. From a finance standpoint, you'll often think about it this way: assets minus liabilities equals the net worth. So we're going to build up our balance sheet over here. We basically have account categories on the left-hand side as opposed to actual accounts, and then we'll get some more complexity adding actual accounts within it. The first thing I'm going to try to do is categorize the account categories, which are going to be asset accounts versus liability accounts. So I'm going to go in here and I'm going to say the liquid assets. It says assets in it, so I'm going to say that's an asset. I'm going to make all assets green. So I'm going to go to the Home tab up top, Font Group, and this little bucket right there. I'm going to make it green, or you can right-click on it and you get the little bucket right there and make it green. Current liabilities, that says liabilities, so I'm going to make that orange. So I'm going to select this item, going to hit the bucket up top. I'm going to make that this orange right there. I'm going to get more nuanced in my color coding later. And notice if you're a classic accountant, I used to think that colors were not accounting like, we did black and white, reports here, but the colors actually help quite a lot. So I recommend using the colors here, and it really helps you to kind of categorize things. But we have long-term liabilities. I'm going to select that, make that orange as well because it says liabilities. Investment assets. So it says assets. I'm going to make it green, hitting the bucket, making that green. And then household assets, I'm going to make that green as well. Now, if you've worked on the business side of things, you might say, hey, these categories sound a little bit different than I'm currently used to. So as we build this, I'll try to point out what the different terms we're going to use here. When you're on the personal side of things, you might want some terms that indicate some more kind of personal indications, especially on like expense accounts, for example, because remember, your objective is different really on the personal side than the business side. Business accounting, the goal is revenue generation. Personal accounting is whatever your personal goals are. So when you have like expense accounts and categories, you might have different rationale as to why you're grouping certain things together. So it's less standardized, which makes it actually more complicated. So let's put our assets up top. I'm going to say assets. Now, typically, we're going to want within the assets to break out our current and long-term assets. That's how it's classically said in business type of accounting. A lot of times in personal finance, you might call it liquid assets because liquid assets sometimes, might ring a little bit better for the personal side. Meaning, when I'm talking about liquid assets, I'm talking about things that we can spend fairly soon in order to pay off our current liabilities. So these are things that we want to be able to access quickly to take action on, as opposed to longer term assets like household goods. Like I can't really sell the couch too easily to pay the phone bill. So I have to break those two things out differently so I can start to think about my short term and long term my liquidity? Can I pay off my certain debts? So I'm gonna group these in the liquid assets. So note this is, and I'm gonna do this with a formula down here. So I'm even the names. I'm gonna say equals on the keyboard. I'm hitting left, 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 and up, picking up that cell. It's really good idea to set up your data whenever possible so that you can pull things together in a formula format so that you can then adjust your data if you need to and make different kind of projections and whatnot going forward. So we'll practice those skills here. I'm gonna then put that into the inner column because the assets, I'll put a colon here, double click colon. It's gonna be a subcategory of the assets. I'm gonna indent this one to Home tab, alignment, indent. We're gonna pull this into the inside. This is classical kind of financial statement reporting, meaning I'm going to indicate that this is a subcategory. Everything below this is going to be a subcategory with the indentation, the colon, and in the inner column. The end result, total assets, then is going to be in the outer column. So then I'm going to be in column E2. I'm going to say equals and then go left, 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 and up to that 5,000 and enter. Now, these liquid assets would include things like cash, savings account, things that are highly liquid. Then I'm going to put the investment assets here. So this, I'm going to do that with a formula again, equals, down, left, left, and then the investment assets. Now, the investment assets are a little tricky. I'm going to go up to the Home tab, font group, or alignment group, and indent. Put my cursor in E3, and I'm going to say equals, and pull over to that 9,200. Note that the investment assets, this is where you could differ in terms of how you're going to be grouping things. Meaning, if you had something in like a retirement account, like an IRA, and it was stocks and bonds or something like that, then you might group that in a different account. That would be like a long-term account. That would be a long-term investment account. If, on the other hand, you have short-term investments that you really have fairly good access to, if you're just putting money into, say, mutual funds or something like that, and they're not under the umbrella of a retirement account, meaning you can access them or sell them, possibly having a tax consequence, but not having a penalty to sell them, then they are still fairly liquid, and you may include them in the current assets or the liquid assets up top. And notice, if you want to call this current assets too, again, you could call them current assets and long-term assets and property, plant, and equipment if you're used to like the business terminology side of things, and there's no generally accepted accounting principles really on the personal side of things to say that you have to use liquid assets versus investment assets. And again, the lack of that kind of standardization is actually a little bit more complicated. So if you're used to the business terminology and you want to use that here, you can. The investments, again, you might want to have a short-term and a long-term investment. The short-term investments, the things that are still fairly liquid, you might put into the liquid assets or current assets. Long-term investments like retirement accounts, you might break out into another account for long-term assets or something like that. And then we have then the household assets. So I'm going to say this equals the household assets and pull that. This is going to be equal to the 97,000. Now this, of course, is similar. Let's indent this, Home tab, alignment, indent, to like property, plant, and equipment. So if I'm talking things like the couch or something like that, the TV and these types of things, these are things that provide its value. They're different than on the business, because remember, if you're talking about property and plant and equipment on the business side of things, like a forklift, the reason you have the forklift is revenue generation. The reason you have these household goods like a TV and a couch is not revenue generation. It's just to live well. And also, just like the property, plant, and equipment, you can't really pay your phone bill with the couch unless you sell it, which is hard to do. And you don't want to have to sell the couch. So that's why you don't want to put it up here in the liquid assets, because I want to be able to compare my liquid assets to my bills that are coming due soon to see if I have enough money to pay them. And I can't pay them off with other assets like the couch or the TV unless I sell those things, which I don't want to do. So then we're going to underline that. Let's go to the Home tab, font group, and underline. And that'll be the total assets, total assets. And let's indent that 2 times now. Home tab, alignment 2 times. That indicates that I'm done with this subcategory, and I'm going to pull that into the outer column now. I'm going to outer column here with the trusty sum function, most common function, equals the SUM. I'm going to say Shift 9. And then you can just highlight from the 5,000, the 29, the 97,000, which will give you this E2 colon E4 and enter. Now I'm going to make this whole thing green just to indicate this is the asset side. So I'm going to try to color code the whole thing here. Home tab, font group, green. And then we got the liabilities. Liabilities. I'll put a colon here. I'll make that orange. Go into the bucket up top in the font group and make that orange. And then we have our liabilities. This is going to be equal to the current liabilities. Current liabilities, I'm going to put that on the inside here. I'm going to indent it as well. Home tab, alignment, indent. Put that into the inner column with our subcategory just like we did before, equals. And then I'm going to pull up to that 2,500 equals to 2,500. Enter. Now the current liabilities, this is an account grouping again. Multiple accounts might be in there. So things that are going to be due within the next year. If I have some kind of like payables is the classical example on the business side of things. Credit card debts possibly, if I'm going to pay them off in the next year or something, could be in the current liabilities as opposed to the long-term liabilities, which could be things like long-term loans, which I'm going to be paying off in a longer period of time that are over a year long. Now, also just realize that when we talk about long-term loans and current liabilities, there's overlap here, and this is another area that gets more complex because if you have like a mortgage or something like that, then it is long-term. It might be 30 years out, but there's a current portion to it, which is the next year out. So you're probably going to put that into the long-term category, but then you might want to like adjust it from time to time to approximate kind of the current portion of the loan. In normal accounting, we do adjusting entries, to adjust that. So just note that there's going to be some kind of overlap, but usually the current liabilities, credit cards, payables that are going to be due within a year, you want to be able to compare that to your liquid assets because you want to make sure that you have the liquid assets enough to pay off your current liabilities that are going to be due within a year. This current liability term, same term as in basically the business finance as well, business accounting. So let's go ahead and make that orange. And then we're going to say long-term. This is going to be equal to the long-term liabilities. And this is going to be equal to the 86,000. So this might be, I'm going to go to the home tab, alignment, indent. This might be like a mortgage or something like that. It might be a car loan that's going to be longer than a year. Typically, it's going to be longer than a year out. But note that for most individual long-term liabilities, there's going to be a short-term component to it. So if you had like a home loan or something like that, you'd probably want to categorize it down here in the long-term liabilities, even though the next 12 months of it is basically current. And you got to kind of keep that in mind. And you could do adjusting entries to kind of figure that out. But a lot of, you might not be doing periodic adjusting entries. So your general categorization would be to take the current liabilities up here, long-term liabilities down below. So then I'm gonna highlight that. I'm gonna go to the home tab, font group, and make that orange. Let's put an underline there. We're gonna go to the home tab, font group, and underline, and this will be total liabilities. And let's double indent that by going to the home tab, alignment, indent 2 times. And I'll put this in the outer column with our trusty sum function equals the SUM, shift 9. And then I'm going to highlight from the 2005 to the 86,000. And there's our trusty sum. Got to have the sum function down. Very important function. Most important, if you'd have nothing else, home tab, font group, underline, you should know the sum function. Home tab, font group, underline. So then we're going to say, and that'll be our net worth. So notice what I'm calculating here is the net worth, which is in essence the equity section. If this was a business, notice we think of the business as separate from us as the individual, even if we're a sole proprietorship. Therefore, the equity represents the amount that the business owes to the owner. So this is our personal finances. So the net worth basically represents the amount of our own assets that we actually have claim to, meaning we don't have them basically promised to somebody else as we do with the liabilities, which represent the fact that we owe somebody that money in the future. So in essence, this is our net worth, which you can calculate by saying it's going to be your assets minus your liabilities, which would be the 22.7. Let's go ahead and make that blue. Notice I'm not going to do any subcategorization here because I only have one account. Home tab, font group, I'm going to make that blue. That's going to be my standard color coding that we'll see going forward. Assets green, liabilities orange, and then the net worth, or the same thing as the equity, is going to be blue. Now, when you look at this balance sheet, note you might start to say, well, why this net worth? How does the income statement fit in to the balance sheet? Assets equal liabilities plus equity. And I mean, because we just got to this equity side by just plugging it in here. Note that the income statement is really the behind. You can think of that as kind of behind the balance sheet. It's the things that got us to the balance sheet. So we're gonna actually break out the time frame. The income statement is giving us a story about part of this equity kind of component here, telling us, what we earned minus the expenses we entered to earn them. So when we think about the income statement, a lot of times with personal finances, you'll kind of put these two things together separately, meaning you'll kind of piece together your balance sheet like this, and then you'll piece together your income statement, and you'll basically do them separately. But note that if you had a continual set of books, if you did this in like an accounting system like QuickBooks, the income statement would feed in to the balance sheet number that's the net worth, and that's how the double entry accounting system will be put together. So we want to first kind of see the categorizations of these things, start to group our accounts together, and then once you have a feel for that, then you get an idea of how these statements are related. And then if you want to get more into the accounting side of things, then you could start to work with the accounting and see how the reports are put together, how you can do your transactions easier. And then if you want to use accounting software, you can use the same business accounting software like QuickBooks or Xero. I'm not advertising any of them, but you don't need a special accounting software. You just need a double entry accounting system, and then your accounts that you're going to be using will be more personalized accounts as opposed to standard business accounts.